this lecture series, we are talking about fundamental of investment. In this subject of fundamental of investment, we are talking about basics of investment, and in today's lecture, I am talking about investment decision process. In my previous lecture on this very topic, I referred the different steps involved in this decision process. Now let me discuss one by one each of these steps which are involved in any investment decision. The very first thing which an investor should do is, it should decide about its investment policy. Each investor has its own or her own investment policy. Depending on your risk return profile, different investors have different goals in life. Some investors want to invest in such assets, such securities which gives them regular income. The goal can be capital appreciation. The goal can be tax benefits. In this way, there can be numerous goals which an investor has in his mind or her mind, and on the basis of that, you will make your investment decision. So, very first thing is, you should be very clear while making any investment what your investment goal is, right? Like say, if I take this example first, that people deposit money in India, very large sum of money is being deposited in banks, in saving fund, in bank fixed deposit. What is the goal of that? The goal is, the objective is that they want that there should be some liquid money with them, that whenever the need arises, they can withdraw it at no time, within no time, right? These days, with the help of the ATM, with the help of the online banking, you can transfer any sum of money anywhere in India or even outside. So people keep money in their saving account. What is their main objective? Saving fund doesn't give you a very high rate of return, but your objective is that you should have a minimum amount. Minimum amount means depending your income level. You want that this much money should have in your bank or with you, which can be utilized at any point of time with no risk. With no risk means there is no scope of diminishing or reduction in the value of that asset or that investment which you have made, and it is perfectly liquid. Liquid in the sense it is as good as cash. We presume that the money which you keep in a saving fund is as good as cash in hand. That is the money which you keep as cash in your home, right? So your objective is that you should have that a minimum money that is liquid. Your investment objective can be regular income. Suppose a person who is in the age group of 55, 57, and the person is going to retire in the age of 60, right? And his job is or her job is not pensionable. What she wants is, after the retirement, that person wants a regular income. So that person's investment decision will be different than the person who is having a regular income, because the person who is having a regular income means who is having a current income and he is young, that person will continue to earn, and from that current income that person can make his day-to-day expenditure. A person who is going to retire, his investment objective may be that he wants that he should make investment so that investment can give him a regular income. Means you want, say for example, you want to invest in those assets which gives you a X sum of money as a regular income so that you can make your household expenditure, right? Your objective can be capital appreciation. That if you presume that you're earning, I'm presuming you're earning 1 lakh rupees per month, and if you're earning 1 lakh rupees per month and your household expenditure is 70,000 rupees or 60,000 rupees, this means that you are saving 30,000 rupees or 40,000 rupees out of your income, right? So this income you have for continuously this investment, this savings you have, and you expect to save this for a longer period of time, say 2 years, 3 years down the line, right? So you will making investment in those avenues, in those asset classes, in those securities where capital appreciation is possible. So you may go for the equity market instead of debt market. Your objective can be tax benefit, right? So tax benefit means sometime we make investment keeping in mind what is the tax implication of this investment, because the real return which you get is your nominal return minus your tax rate. That will be your approximate real return. So objective can be the tax benefit, right? So you should be very clear what your investment goal is, what your investment policy is. So objectives are framed on the basis of risk return preference. So each individual has her own risk return profile. Depending on your risk return profile, your investment decision will be, right? So your investment decision should be or will be on the basis of your risk return profile. There are certain investors who are ready to take high risk, right? So those investors who are ready to take high risk, they will invest in such securities where income is fluctuating. There are certain investors who do not want to take risk. They want that even if they earn less on their investment, but the money should be safe, 100% safe. So they will prefer to invest in government bonds. They will prefer to invest in gilt-edge securities. Gilt-edge securities means normally the securities that is issued by the government of India, right? They may go for the debt fund. So it all depends on your risk point. And normally there is a positive relation. I'm not saying it is a perfect and it is always there, but normally there is a positive correlation between risk and return. Higher is the risk, higher is the return. Right? Lower is the risk, lower is the return. This is a general rule of risk return. The other investment goal or policy can be period of investment or investment horizon plays an important role while making your investment decision, right? For what period, for how many years, for how many months you are going to invest this money, right? Suppose a person who is in the age of 45, 50 and that person has to get his or her daughter married in the time of span of 2-3 years. So the person's investment horizon is, or son's marriage, so investment horizon 2-3 years. That person wants that whatever investment I am making within 2-3 years, I should able to get this money back. There are certain type of investment which you are investing for a very long period of time. So your investment will change. Like if you invest in the real estate, you don't invest because the cost involved in investing in the real estate is reasonably high, is higher than as compared to investment in stock market, or I will say investment in the bank fixed deposit, or investment in other debt securities, right? So you invest that money only in the real estate which you can spare for a longer period of time, right? So your investment decision will be influenced by, will depend on your investment horizon, means the period for which you want to make the investment. What it implies is that you must determine your investment policy, what your goals are. Here, your goals, your investment policy will determine where you should invest, or where you should ideally be invest, which can match with your goals, which you can match with your objectives of investment, right? The other important aspect is the build up an inventory of securities. Depending on your objective, you select, you choose, you list the different type of securities that are available which matches your objective. Prepare the list of all the securities available for investment, filtering those securities as per investment objective and investment horizon. Means, suppose I am talking about fixed income, that I want, my objective is I should get a regular income, I should get a fixed income, I should get a fixed return on my investment. Then I will list the securities which give me a regular return. I may buy government bonds, I may buy bonds or debentures, you may say, that is being issued by the corporates, companies. I may go for the fixed deposits in the bank. I may deposit money in the public provident fund or in my GPF or CPF, as the case may be. GPF means general provident fund or central provident fund. There are different type of investment avenues. There are different investment avenues which are available to an investor, which are available to those investors who wants fixed return on their investment, right? So again, depending on your risk profile, depending on your investment horizon, right, depending on various objectives of yours, you will list the different securities. And once you know that these are the different securities in which you can invest, then you filter those securities as per your own objective. Like if I say government bonds and corporate bonds. Within the corporate bonds, there are bonds which are issued by the blue chip companies. Blue chip companies are those companies which are very highly rated by the credit agencies, and the bonds that are being issued by not so highly rated companies, they are less rated companies, they are mid-segment companies, small companies, their risk is high. But these companies where the risk is high, they normally offer higher rate of interest on their debentures or on their bonds, right? But as compared to the blue chip companies, as compared to the large companies which have prudent track record. So again, it will depend on your risk profile. It will depend on your objective, right? Say 10-year government bonds are considered to be very safe investment, but that investment horizon is 10 years, right? Although you may argue that it is tradable in the market, but the bonds, if you are investing a small sum of money, normally in India, trading the bonds is not as easy as compared to trading of equities, right? So depending on your investment horizon, depending on your objective, you filter your different securities as per your objective. So second step involved is, the first step is you decide your goals, you decide your investment planning. Second is building an inventory of your securities. Building an investment of your securities means that you list or you try to find out what are the different securities which are available, which matches your investment objective. The third step is performing security analysis. Friends, this is the most vital part of your investment decision process. And here my focus will be on the equity, stocks, common stocks, right, shares. So performing security analysis means analyzing the security with the risk and return profile. Like I would say there are three aspects involved in it. There are three ways in which we analyze. One is called fundamental analysis, the other is called technical analysis, and third is called efficient market hypothesis. Let me talk each of these in very brief. Although we will be talking this in detail, we'll have a separate discussion on fundamental analysis, technical analysis, efficient market hypothesis. But let me point out just here, since it is the introductory part, the meaning of it. What is fundamental analysis? In the fundamental analysis, which is a long term of nature, we tries to find out the intrinsic value of an asset. Intrinsic value means you may call it a real worth of an asset. If you want to invest in the stock of, in the share of X company, what should be the intrinsic value of that X company? Share price I am talking of, right? And what should be the intrinsic value, what should be the value depends on hundreds of factors. Like to name a few, what is earning per share? What is the return on asset? What is the return on equity? What is the growth of sales? What is the growth of profit over a period of time? What is the price earning ratio? Price earning ratio means how many times the price of the share is that of its earning per share. So there are various factors on the basis of which we tries to find out the intrinsic value of a share. And if the current market price is more than the intrinsic value of the share, the investment should be avoided. If the intrinsic value is less than, the market price is less than the intrinsic value of the asset, it means that share is underpriced and one should think of investing in that share. I am purely talking from fundamental analysis point of view. So what it means at this point of time, fundamental analysis means that on the basis of your knowledge, on the basis of certain tools which investor should know, she tries to make the value of that share, intrinsic value of that share, and if the intrinsic value is less than the market price, then there is a sound investment decision that can be a sound investment and that should be made. So one is fundamental analysis in which we tries to find out the real worth of that asset. The other is technical analysis, which is of short-term nature. What we do in the technical analysis is we tries to find out the time of buying and the price at which we should buy. Fundamental analysis tells you the worth of an asset. Technical analysis tells you when to buy and at what price to buy. See, technical analysis is based on past price behavior of a equity, of a share. We presume history repeats itself. It's a basic presumption, one of the assumptions of technical analysis, that history repeats itself. By analyzing the past data, means trend analysis we call it, or with the help of the moving averages, you tries to find out in future what will be the price of this share, right? By judging, by studying the price behavior, the volume behavior, you decide that what will be the future price or what is the right time to buy, right? So technical analysis, we study the technical aspect in the sense that what is the right time to buy and what is the right price to buy, right? This we study on the basis of past data which is available. All those companies which are listed in the stock exchange, they have a price behavior. By analyzing this price behavior, by analyzing the volume behavior, right? Like for example, just giving an example, if the share price of a company is rising with a large volume, it means there is a larger purchase and sale that is taking place. We presume that technically the share is sound, and in time to come, I am talking of the short term, this share price will go up, because every day for the last few days the share price is rising and with a larger volume. High volume and high price means price is rising. It's an indicator that the technical indicator that the share price is expected to rise even further, right? The third is efficient market hypothesis. Efficient market hypothesis presumes that whatever the equity price in the market is, that reflects all the information that is available in the market, or all the information that is available which affects the share price to the investor, right? So efficient market hypothesis presumes that no price is high price or no price is low price. It's all depends on the market information, and presumably if market information is perfect, then the share price is also perfect, means is the right price. Whatever the price that is being shown in the stock market, shown means the price at which the stock is being traded, that is the right price, right? So security analysis can be made by these three methods: fundamental analysis, technical analysis, and efficient market analysis. Next important aspect is constructing portfolio, analyzing portfolio, and selecting the optimal portfolio. Friends, again this is an important aspect. By making fundamental analysis, by making technical analysis, now you make portfolio, you construct your portfolio. What is portfolio? Portfolio means different equity. If I talking of the equity portfolio only, different equities, the combination of shares that you possess in your investments, that is, you are creating a portfolio, right? So a portfolio is a combination of two or more securities in which an investor may prefer to hold as investment, right? So what we do is that by analyzing, I said you determine your objective. On the basis of your objective, on the basis of your goal, then you list the different securities that are available, and then out of those securities which you have listed, you make the fundamental analysis and technical analysis. Once this passes through the fundamental analysis and technical analysis, and you decide to invest in n number of securities, on the basis of that you choose your portfolio. You make the portfolio, means different securities which you want. It all depends on the amount of investable funds you have, and basic rule is that, as we have discussed in our previous discussions also, that you must diversify, right? So on keeping in mind diversification, keeping in mind the risk profile of different companies, keeping in mind the track record of the companies, you build in portfolio which is a ideal portfolio which gives you good return. What is ideal portfolio? Ideal portfolio is the right portfolio. It all depends on your own risk profile, right? It all depends on what return you expect with your investments, right? So after security analysis, an investor construct all possible portfolios and then select the optimum portfolio, right? So there are whole host of portfolio you can construct. Out of those portfolios, you build optimum portfolio. What is optimum portfolio? I would simply say optimum portfolio is that portfolio which gives you maximum return with a given level of risk. Or I'll put it this way, which gives you minimum risk for a given level of return, right? So you may say in either way is same thing, but we tries to build. It's not that always we are able to build. It all depends on the prudence of the investor. We tries to build optimum portfolio which gives you a minimum risk for a given level of return, or for a given level of return where the risk is minimum, that is called the optimum portfolio. For selecting the optimum portfolio, one need to consider the risk return preference of the risk investor. The next important aspect is portfolio revision. Friends, no portfolio is always fixed, is always remains same. Portfolio is always subject to revision. It doesn't mean you revise your portfolio on a day-to-day basis, but at regular intervals, a prudent investor should or can revise the portfolio. Because since we know the markets are dynamic, situations are dynamic, your goals can be dynamic, right? With the change of the time, your goals may change. With the change in the market condition, with the change in the security price, you require to revise your portfolio. Like, if I give an example, exactly 1 year back, in the March 2020, when this lockdown was declared by the different countries in the world, the stock market crashed throughout, right? At that point of time, the share price were very low. Those who were long investors, right, they built their portfolio more of shares, stocks, and less of fixed interest securities, because at that point of time the share prices were quite cheap. But as in the year 2021, March 2021, stock market has increased. It is almost touching 49,000. If I talk about the Sensex, 49,500. Sensex is an index number, index of the Bombay Stock Exchange, or if I call it Nifty, is a index of the share index of the National Stock Exchange. So if I talk of these index, today the Nifty is 14,500 odd level and the Sensex is 49,000 around 400. So at this price, from the last 1 year, equity prices have gone up substantially. So here, who are not ready, those investors who are risk averse or who are ready to take less risk, today we are revising our portfolio and we are making more investor, or the investor of that class will make more investment in the debt and less investment in the equity. Like say, for example, in the mutual funds, there are balanced funds. So in the balanced fund, the fund manager changes the combination of debt and equity depending on the conditions in the stock market, right? So as the security prices, suppose I buy one particular share and that share price goes up substantially and I feel that it has gone up beyond the intrinsic value of the share, then I may sell that share and buy some other one which I feel is a cheap stock, which is having low value in the stock market in the expectation that will go up. So as the security prices changes, you may have to change your portfolio, right? Change in the market conditions. Suppose if the market is booming, at that point of time, your decision will be different. If the stock market is continuously falling, so you will not like to take bigger risk at that point of time where the stock market is continuously falling. So you will have to revise your portfolio. See, in this pandemic of corona, right, many pharma companies are doing very well. So at this period of time, many portfolio managers are investing more in the pharma companies, right? So market conditions are changing. So because of the change in the market conditions, change in the economic conditions, change in the environment, people are revising their portfolio, right? So, and again, depends on your investment objective. So what it means is that no investment or no portfolio is static forever. Portfolio one should revise as the condition changes, as the price of the security changes, as the market condition changes, or as your investment objectives. So portfolio revision is necessary to keep the portfolio attractive and profitable. Next step is portfolio performance evaluation. Friends, once you construct your portfolio, you should also see whether this portfolio is giving you a return which is higher than the benchmark index. Supposing benchmark index can be Nifty 50. Nifty 50 means there are 50 companies in the National Stock Exchange index, which is called Nifty. The index of the National Stock Exchange is called Nifty. So there are 50 companies in it. And the portfolio which you have built for yourself, whether this portfolio is giving you a return higher than the Nifty 50 portfolio if you have invested in the large stocks or not. What it means is that you have to continuous basis evaluate your performance of your portfolio, that what return this portfolio is giving to you. There are various ratios with the help of which we can evaluate our portfolio, like called Sharpe ratio, Trainer's ratio, Jensen-Alpha ratio, right? We will be discussing later in detail these things in time to come. So it helps in determining whether the portfolio has performed better than the benchmark portfolio, right? So benchmark portfolio, depending on the type of investment you have made, on the basis of that there is a benchmark. As I say, if I have invested in the large stocks, in the companies which are in the large companies category, then I will compare my performance of my portfolio with the Nifty 50 companies, right? So friends, these are the different steps involved in your basically the process of your decision of how you make the investment. So there are 6 different steps, friends, when we should keep in mind that you're setting up your investment goals, building up an inventory of securities, performing security analysis, right? Constructing portfolio analysis, portfolio and selecting the optimum portfolio, portfolio performance evaluation and management, and portfolio revision. Portfolio revision means that if you feel that on a basis of evaluation of your portfolio, there is a need of changing the securities, one must change, keeping in mind the future, so that your portfolio can give you good return. So friends, with these words, thank you very much for today. Thank you.